Let's talk about trade. You mentioned the trade war and the risk that this presents. We have the two things. We have a decision by the United States government to sign or not sign a trade deal with China. We also have a president that's very eager to see rates lower, and there are those that look at this situation and say there's a moral hazard problem. The president could hold off signing a trade deal, allow the Federal Reserve to cut rates 2 or 3 times, and then sign a trade deal, and that big risk then goes away. That's a problem.
My assessment is that trade uncertainty used to be relatively low. This used to be an issue that was, relatively speaking, on the back burner. The president has moved it to the front burner. Now I think trade uncertainty is high, and I don't see that uncertainty declining anytime soon. And I think other countries are getting into the game. They're wondering about their own trade relationships. They're wondering if they could get better deals or renegotiate. So I think we're in for a long period of higher trade uncertainty than what we're used to. And it's not just the U.S., but obviously something like Brexit or other things around the world. I think the Chinese are rethinking their trade policy. So I think we're just going to have to cope with the idea that this is going to be a volatile area of policy, at least over the forecast horizon, and maybe even much longer than that. Whereas previously we kind of thought of this as, okay, that was something that was decided via the post-war trade liberalization program.
Just to be clear, you're not anticipating a trade deal between the United States and China anytime this year?
Well, I think they could come to a nominal deal, but things could come up later that then, provoke more uncertainty around that. So I just think that countries are reconsidering what their trade relationships are, and I think that for investors, that just means, well, you gotta be ready that the trade relationships might change on a dime.
I think investors are more optimistic than you right now.
I think the story that you're going to all of a sudden reach a deal with China and then we're not going to hear anything more about trade over the next 5 years, I think that's a fantasy. These ideas have been brought out of the box, and now we're going to have to wrestle with them, and they're difficult to solve.
Let's talk about new Fed members, potential Fed members joining. There's a concern out there that the nominations are people that are aligned with this White House, with the president, on cutting rates, but other things. If he changes his mind, so will they. Are you worried about the dilution of the independence of the Fed?
One of the potential nominees is my research director, Chris Waller. He was a chaired professor at Notre Dame. Then he came to work at the Fed. He has long experience on the FOMC, long research record. A lot of his research is all about Fed independence. About half his papers are about Fed independence. So he's actually a world expert on that. And I think he'd be a very good person to put very much in the tradition of the technocratic appointments that we've put at the Fed historically.
Let's talk about Judy Shelton then. Is she a good choice?
I don't know Judy Shelton as well. I have met her. I met her at a conference in Paris last year. I thought she was quite articulate, but she'll have to defend her own views.
I mean, her views...
She's very capable of doing that.
I would agree with you. She did, though, say in the last year that she favors repegging the US dollar to the gold standard. Is that a good idea?
The gold standard, the U.S. did have a gold standard at one time, and then really didn't fully get off gold until Nixon in the early 1970s. So there is a literature that talks about gold and the pluses and minuses. I've said publicly before that I felt inflation targeting was the modern incarnation of the gold standard. Because what you're doing is putting some discipline around the future issuance of the currency, and this is stabilizing the inflation outcomes compared to what you would otherwise get, which is exactly what you'd be trying to do under the gold standard. But with gold, you've got mining and, how much gold are you going to find and these kinds of issues. And in some cases, it didn't work out well internationally.
Would you agree that it's inconsistent of someone to want to peg the US dollar to gold, but also be wanting to cut rates? You're trying to enforce a level of discipline on the one hand and then trying to push for lower rates on the other.
Yeah, I mean, I don't know. We don't have much inflation today. So, my idea is set the inflation target, manage to it, and hit it. It's the credibility of the central bank that is really the critical variable here.
Sounds like you two could have some lively discussions going forward. All right, let's talk about the US dollar, because this is something else.
I would say this about this whole issue. A lot of this was discussed in the 1970s when inflation was high and variable. That would be the natural time to talk about commodity standards, and people did talk about commodity standards. And the outcome of that debate was to not go to a commodity standard, but try to get the central bank to do what they're supposed to do. That was the Volcker disinflation. And then since then, certainly since 1995 or so, inflation really has been pretty close to 2% the whole time.
Yeah, I'll call it inconsistent. All right, let's talk about the US dollar, because this is something else where the president has said he'd like a weaker US dollar. And we've also seen currency intervention from the Treasury in the past too. The Fed may not have liked it, but they went hand in hand with it. What's the likelihood that we see a call from this White House for direct intervention to weaken the dollar? And would the Fed stand by and go with it?
The academic literature on this says it's very hard to intervene and have much impact on the dollar, especially for very thickly traded markets like dollar yen or dollar euro.
But if the White House said, look, we're abandoning our strong dollar policy outright, that would have an impact.
It's very hard to have an impact. And the other thing about exchange rates is it depends what the other guy's doing. So it's a relative game where the other country might be trying to do the same thing, and then nothing happens to the exchange rate. So I think, this idea of competitive devaluation, which is something that happened in the 30s, is probably not something we want to get into. We want to run a great policy for the U.S., get great innovation, use the great technology we have, use the workforce that we have. That's how you have a great economy. I don't think you can depreciate your way to success.
Very quickly, because we've got 1 minute left, your views on Facebook Libra, the cryptocurrency alternative, future alternative to the dollar, a big threat?
I'm actually going to talk this in a day or two at a conference on cryptocurrency. My session is on cryptocurrency, so I'll have some good comments about that there, I hope.
Can you give us a teaser? For
this is what I've said about this in the past is that there are ideas from monetary theory, and then there are ideas that the computer science guys have. They don't always match very well. So that's mostly what my talk is about.
So you're not a fan at this stage?
I don't think that cryptocurrency really solves any fundamental problems that are natural to any currency. And some of the other points are there's a lot of currency competition already, so you bring another currency in, it doesn't really make any difference. There's always an equilibrium where no one wants to hold the currency. Most of the cryptocurrencies are in that equilibrium. Today they're worth zero. So these are some of the things I like to bring up.
Are you on Facebook?
I'm not on Facebook. Corporately, we're on Facebook. Yeah.
We'll go there. Jim, fantastic to have you.
All right, great to have you.
Jim
Great
Bullard,
to be here. Yeah.
President of the St. Louis Fed.